very excited to have all the way over from Switzerland. I believe that's where Ronnie is, but Ronald Peter Stöferle will let me know if he is somewhere else. He is an international man, gentleman really, of mining and metals. I first encountered Ronnie going over to London and to Zurich for some of the shows put on by our friends at the Precious Metal Summit. They always do such a fantastic job. And Ronnie just gave highlight keynote talks there, really creative, dives into a lot of numbers around gold prices and what's going on in the gold market. And really interesting, when I saw him speak last year in November in Zurich, pretty much everything that he said came to fruition over the next 6-7 months in the gold price movement. So pretty powerful speaker, really excited to have him here, but I'm going on too much about him because I'm going to let our also amazing person, Alicia Hyatt, who is editor-in-chief of Canadian Mining Journal, do the introduction. She'll be conducting the interview with Ronnie. Alicia always does such a great job on these fireside chats. Now, the Canadian Mining Journal, most of you should know, it's one of Canada's oldest mining publication. Alicia herself has nearly 15 years of experience as a mining journalist, covering projects and mines, new technology, and environmental and social issues related to mining. She's also editor of Diamonds in Canada magazine, and before joining CMJ in 2017, she served as editor of the Northern Miners many publications, where I worked side by side with Alicia. Been a pleasure and an honor to work alongside Alicia all these years. And Alicia, are you with us? There you are, and there's
I'm
Ronnie.
Right here.
Great to see you virtually. Hey, Ronnie, excellent to see you.
Hi, Anthony. Hi, Alicia.
Hi,
I'm going to get out of the way. Let you two take it away. Have fun.
Thank you so much, Anthony. It's my pleasure to further introduce Ronald Peter Stöferle. Ronald Peter, or Ronnie, is a managing partner and fund manager with Incrementum AG, where he is responsible for research and portfolio management. I won't go through his entire bio, but I will highlight that he has co-authored 2 books, including Austrian School for Investors. And he's probably best known for the In Gold We Trust report, which is an annual report he started in 2007. And that has become one of the benchmark publications on gold, money, and inflation. And welcome, Ronnie. Thank you so much for joining us.
Hi, Alicia. Thank you very much for having me. Thank you.
And where are you right now?
I'm currently in Vienna, working from home. I closed the door, I locked the door, so my kids cannot run in. But usually our office is in Liechtenstein, close to the, so I'm having a flat close to the border, and now I'm commuting between Vienna and Liechtenstein. Normally I'm traveling quite a lot to conferences all over the globe, but yeah, I mean, it is what it is. So I truly enjoy being virtually here at this conference and look forward to our discussion.
Well, thank you so much again for joining us. This year's In Gold We Trust report is massive. It's 350 pages. It's full of information analyzing gold from every angle. But before we get into some of the specifics, can you go back and tell us why you started the report in 2007 and how you first got interested in gold?
Well, it's a long story. First of all, over here in Austria, and I think it's very similar also in Germany, I would say that we've got gold in our monetary DNA. So for me, it was just normal to get little gold coins, those Theresienthaler, Maria Theresienthaler, from my grandparents for every bigger occasion, like, birthday or Christmas. And they lived through the hyperinflation, and they basically lived through 4 currency reform. So for them, having gold was some sort of a monetary insurance, and it felt really natural for them having a part of the savings and investments in gold. So it was always something that fascinated me, but I started investing in the equity markets already when I was 12 years old. So I had a passion for financial markets. Went through the dot-com boom and the dot-com bust, then tried to learn something about financial markets and investing on university. Didn't really learn too much about it. And then joined a bank in Vienna. And I always invested in small caps, and I had a passion for companies with low market valuation. And a friend of mine, he said, you should have a look at this mining stock, and it was Osisko Exploration back then. And as you know, Osisko, that's been one of the biggest success stories in Canadian mining over the last couple of decades, and it turned out as a 40 bagger. Now I don't know if that's a blessing or a curse. Of course, I thought, investing in junior miners, that's pretty easy, pretty rewarding. But because of that, I went to my boss in the research department and I asked him, hey, could I write like a special report about gold? I will write it over the weekends, but just give me the opportunity. And he said, yes, go ahead. So starting in 2007, I wrote my first In Gold We Trust report. It was a, let's say, very basic analysis of the supply-demand picture. And only then I found out more about, our monetary history, about hyperinflation, about the stock-to-flow ratio, about the importance of gold for our monetary system, about the Austrian School of Economics. And yeah, I took the red pill and really read everything that I could get about those topics, those macro topics. And from then on, every report got bigger and bigger. And 2012, I quitted my job and set up my own company based in Liechtenstein together with some gentlemen from Switzerland. And we're now investing in mining companies, especially in the gold and silver space. And I still, because it's what I love to do and it's really my passion, I still publish the In Gold We Trust report. As you've said, it's quite a brick. It's 350 pages. But there's just so much to analyze, and there are so many angles, like the whole macro picture, inflation, central banks. Then there's of course the whole mining space that is highly interesting, but we also discuss like historical topics like gold in the Bible, for example. So it is really kind of a book that I'm publishing every year together with my team. And yeah, we're already working on the In Gold We Trust 2021.
So we're all glad that you kept up the report all these years and that it's grown. It's a fantastic resource. And I'll just point out to our audience that it is available for free on the Incrementum website. So check it out. Let's kind of start our conversation with the pandemic. We're about 6 months into it now, and we've seen a lot of strength in gold as a result of its safe haven status. Recently set a new nominal all-time high of $2,089 per ounce US. But the gold price started to move up before the pandemic. So can you kind of break down some of the most important drivers there and their relative importance to gold?
Well, in short, gold, silver, and the miners are really in a stealth bull market at the moment. You can tell that gold is rising in every currency. Gold is rising relative to the bond market. It is relative. It shows relative strength to the stock market. Miners are outperforming gold itself. Junior miners are outperforming large caps. So those are all confirmations from my point of view that this is really a strong bull market. The bull market itself already started much earlier. We shouldn't forget that we saw new all-time highs in basically every currency already in 2019. We saw new all-time highs in Swiss francs, in euros, of course, in the British pound, and so on, in every currency but the US dollar. And I think this current stage, this so-called public participation phase, of this bull market, it began basically with the breakout that we saw last year. We saw this massive consolidation phase, and gold failed to break this 1360 to 1380 resistance, I think 5 or 6 times. And then we went above this resistance zone, and then really momentum kicked in. And I can tell that from this moment on, there were many institutional players players that were on the sidelines, they said, okay, we have to get some allocation in gold and in the mining space. So this is really when the second stage of this bull market started. Now, what are the most important drivers? From my point of view, I think it's important to say it is not the price of gold that is rising. It is rather the purchasing power of fiat money that is just falling. And we can see that this is happening in basically every currency. Now, of course, the US dollar is extremely weak, but we're in these currency wars. So basically everybody wants to stimulate their economies by weak currencies. Now gold is not participating in these currency wars. The second driver that I see is, first of all, that we're seeing globalized zero interest rate policy. We just saw that US 10-year yields at an all-time low. And of course, this whole development at the moment, it is all about liquidity, about excess liquidity. So just to give you a number, we're seeing unprecedented growth of M2, which is 24% at the moment, and 40% for M1 for the past year. M2 growth in the 1970s never ran above 14% on a year-on-year basis. So, of course, this whole fiscal and monetary stimulus that we're seeing due to the whole COVID crisis is a big additional catalyst for the price of gold. Now, if you ask me, is this a strong bull market? When is it going to be over? I think if you want to bet against gold, you have to ask yourself, okay, when will rates start to rise again? When will central bankers really make a U-turn? When will we see a stronger US dollar and higher nominal rates? Is deflation really a big concern? And if you say, okay, that's got a fair chance, the possibilities are high, then of course you should lighten up on your gold allocation. But I don't think so. I think this is a very strong bull market. Of course, we will see some periods of consolidation. The price of gold has to take a breather sometimes, but I think this is really a strong bull market that will be around for the next couple of years probably.
So one of the main drivers of the gold price that's outlined in the In Gold We Trust report is inflation. In a recessionary context, which we're in right now, inflation isn't top of mind for a lot of people. Although I think that might have changed a little bit with the Federal Reserve policy change announcement last week. Can you tell us why you're concerned about a comeback in inflation and what that means for gold? I know you touched on that a little bit, but go into it a little bit more.
Of course, I mean, Dave Rosenberg, he said recently that, talking about inflation or even stagflation right now is as if I'm talking about desserts and we're just serving the appetizers. But, we have to stay ahead of the curve and anticipate what will happen. And I think that inflation or even stagflation are a scenario that should be taken into account going forward. And in this environment, of course, gold will benefit as a classic store of value. Now, taking a step back, I would say, with the whole COVID crisis, what happened? This mountain of debt that was already extremely high got even higher. In the US, the official forecast by the IMF is we will go from 109% of GDP to 141%. In the Eurozone, from 84% to 105%. Those are pretty conservative estimates, I would say. We have seen 35 trillion in fiscal and monetary stimulus over the last couple of months, and there will be much more stimulus. Now, why is it important for gold? The higher the debt, the bigger the desire for inflation and the bigger the fear of deflation. So we already saw in March and April that the Federal Reserve and central banks all over the globe, they were really concerned about this stress situation, this deflationary pressure, and they did really they took out the bazooka and stimulated in a size that we've never seen before. But this time around, it wasn't only monetary stimulus, it was also fiscal stimulus. Now, last week we basically saw that the Federal Reserve made a really a major step, I would say. So Jay Powell said, first of all, until 2023, we won't see rising rates. Then, and this is probably more important even, the FOMC now seeks to achieve inflation that averages 2% over time. So this is some sort of a flexible form of average inflation target. So they know, and they openly said that actually inflation numbers were way too low over the last couple of years. So they will allow inflation to overshoot over the next couple of years. So we will see low rates, or let's say low real rates, forever, basically. So I think there is some sort of a Japanese scenario that we might be facing. Now, coming back to the triggers for inflation, I think first of all, the Austrian School of Economics says inflation is basically a monetary expansion. Rising prices is only a consequence of this monetary expansion. And we should not forget that we already saw massive asset price inflation over the last couple of years. Real estate, equity markets, the art market, of course, the bond market. So the next stage could or should be price inflation. And the triggers will definitely be, first of all, this whole trend to deglobalization. Then we're seeing a structural shift. Basically, the power to create money is going to governments from central banks. So there were lots of programs initiated in the last couple of months with government-backed loan guarantees. So basically now the government says, okay, bank, you have to hand out so many billion or trillion in loans because we have to finance, this infrastructure program, we have to finance a Green New Deal, whatever. And from my point of view, COVID is really the door opener for MMT, for helicopter money, and for UBI. So those are all triggers that from my point of view will be highly inflationary. It is not a topic that I would expect to happen in the next couple of weeks, but I think over the course of the next 1 or 2 years, inflation will become a major concern for financial markets.
This year's In Gold We Trust report is subtitled The Dawning of a Golden Decade. And you go so far as to make a forecast for gold by the end of the decade of $4,800 per ounce. Talk to us about that number.
Well, that sounds like a pretty high estimate, but in this report we really try to explain the big picture until the end of this decade. We are creating some scenarios what might happen, and then we really, I'm not an economist, so I don't work with extremely complex models, and the problem of those models most of the time is that they don't work in stress situations. But we said, okay, what are the most important drivers for the price of gold? And we came up with a couple of factors and put them into a prediction model that is based on monetary growth, but also the gold backing of the US dollar. And then we did some probabilities, and we came to a probability weighted price of $4,800 at the end of this decade. Now people would say $4,800, that's way too much, but that's a compound annual growth rate of 10.1% until 2030. Now, is that possible, 10.1% every year? I think it is possible. I mean, this year, since January, gold is up 26%. So why shouldn't this be possible? And from my point of view, what we're really experiencing now is some sort of a revival or a renaissance of gold in classical asset management. This is really a big trend that I'm seeing at the moment.
Can you tell us about some of the metrics you use to measure the value of gold stocks versus the price of gold, and whether gold stocks are undervalued, and what you're seeing right now with that?
Well, we've got a couple of charts in the report. For example, the Barron's Gold Mining Index, which is probably the oldest available gold mining index. And currently the BGMI relative to gold is at the lowest level in 78 years, I think. So we're miles below the long-term median, and we're close to an all-time low. And this is not only the BGMI, we can also see that, for example, the gold box index, the HUY, is now trading at 350, while when gold was trading at 1900 in the year 2011, the HUY was trading at 600. So I think that the mining space, both on an absolute basis but also on a relative basis, is still pretty cheap. Of course, we've seen lots of movement over the last couple of months. But I think this is only the beginning of a really stealth bull market in the mining space.
One of the big drivers of gold stocks is institutional demand. And of course, there was a big stir when Warren Buffett, who's never been a big fan of gold, made a recent investment in Barrick Gold. Can you tell us about this institutional demand and generalist demand and how it's likely to develop over the next few years?
Well, I think, we only have to have a look at the volume that is traded in the large caps. Have a look at the charts of Agnico, of Newmont, of Alamos, Barrick, Kinross, Franco. Huge volumes were traded over the last couple of weeks, and I think the charts of most of the mining stocks really look fantastic. If we put those numbers into perspective, the market cap of all miners at the moment is 550 billion, which is only a little over 1/4 of Apple's market cap. Now, I think what you rightly said, it is really the generalists that are coming into the mining space. And I think they see that, first of all, those companies have got, the mining space has got lots of momentum at the moment. We are seeing that, the companies are refocusing on harvesting cash, on displaying prudent capital allocation, returning cash to shareholders, and I think they have the best relative and absolute returns versus other industries. Just to give you a perspective, Newmont returned $2 billion to shareholders through dividends and share buybacks since 2019. Evolution Mining is paying dividends based on cash flow targeting, roughly 50% of their cash flows. Kirkland, for example, said that they are returning more than $600 per ounce of gold that they produce via share repurchases and dividends. So I think that really we have seen a massive creative destruction happening in the sector, and now I think the companies really learned from their mistakes that they did in the previous bull market. That doesn't mean that some of them won't screw up again over the course of this bull market, but I think at the moment the leverage on higher gold prices is probably higher than ever. And I think, coming back to this topic, that they learned their lesson. They have barely engaged in share dilution over the last couple of months. So in aggregate, the top 50 gold and silver miners by market cap have only issued 266 million in equity over the last 12 months, which is the second lowest amount of 12-month equity issuance in the last 3 decades. And they also have paid down 200 million in debt in the last quarter. So those are all very encouraging developments. Now, coming back to Warren Buffett, I think we shouldn't over emphasize that. That's less than 0.2% of Berkshire's equity capital. I think that at the moment, I just read that Apple is 50% of Berkshire's portfolio, which is $47 per B share. So a 1% daily change in Apple stock price is worth more than double the entire Barrick investment. So it is not a big investment, but I think it is important to say that, first of all, Buffett didn't buy gold. He bought a gold miner, which is a big difference, of course. And he sold more than a quarter of his Wells Fargo position, 60% of his JP Morgan, and he liquidated the whole Goldman Sachs position. So my interpretation would be he's buying real assets and he's selling financial assets. Now, another sign that I saw last week, the Ohio Police and Fire Pension Fund, they came out and they said they're going for a 5% allocation in gold. So I think those are all signs that gold is really becoming mainstream and that gold is being reconsidered as an important part of institutionals' portfolios.
So you mentioned Apple a little while ago and its valuation. Another interesting aspect of all of this is the potential for a sector rotation away from tech stocks and into mining stocks, but the tech stocks are still on a tear. So what would the catalyst for that rotation be?
Well, actually, I don't really see this rotation happening. We shouldn't forget that the market is really, I mean, it is, just to give you one example, the Russell 3000 was up 2% in the last month. Nasdaq was up 12%. So there's really big momentum in those tech companies. But I'm a bit concerned, I would say. Just have a look at Apple. The market cap has soared 120% in the last year, while sales are up 5.7% and profits are up 5%. On a 3-year basis, market cap has expanded at a 36.1% annual rate. Sales are up 7% annualized and net earnings 8%. So I think, I wouldn't chase this market, but it doesn't necessarily mean that investors will go out of the tech space and will go into the mining space. But I think what really encourages my view is that there's lots of really sophisticated investors coming into the mining space that that are in for the long game and they understand the space, and this is really much more important than those momentum chasers.
Let's touch on silver a little bit. I wanted to quote from the report, quote, "We will be surprised if the decade or two ahead are not some of the best in silver's long history." Tell us about the potential you see there.
Well, when we published a report in end of May, we said that silver is unloved, it is unwanted, and is mocked. So for a prudent and for a contrarian-minded investor, there has rarely been a better time than now to invest in silver. Back then, the gold-silver ratio was very close to its all-time high in history, which was 125, and we saw this ratio at 125 in March. Now, of course, over the last couple of weeks, we have seen big momentum in silver. It is really, we could tell that silver is some sort of a, it's a high beta play. It's gold on steroids, basically. And we always said that it is always gold that moves first, then it's silver following. So the gold-silver ratio should be falling. And then it is the commodity space that is following. And we can see at the moment that, first of all, industrial metals, copper, iron ore are doing extremely well, but we are now also seeing the agricultural space that is starting to move. So I think it is really a strong commodity bull market that we're experiencing now. you probably realize that I'm pretty bullish gold. So of course I'm extremely bullish on silver. Perhaps we'll take a breather over the next couple of weeks. It seems that momentum is kind of fading, but we're also seeing from a supply demand view that we're seeing several supply constraints. So of the 8 sources of silver supply, only 2 are not in a state of stagnation or contraction. We can think of one supply that might even flip to become a source of demand, as it happened with gold, and that source is government. Back in the days, it was normal for governments, for central banks, to have silver as part of their reserves. And I just think that going forward, as we're seeing now with gold, many institutional players will consider gold over the next couple of quarters, but then they will also think, okay, we want and we need a little bit more beta, and then of course they will end up with silver. And that's what makes it so interesting, as it's an extremely small market. It's tiny compared to the gold market. So if there's some money piling into the silver market, it's going to have a huge impact.
I want to save some time for questions from the audience, but so I'd like to invite people to ask questions if they have any. I see one. Where can we get a copy of the In Gold We Trust report? It is available on the website, as you mentioned. I don't know if I saw you had a hard copy. I was surprised that you've actually printed it, actually. But can people get a copy of that too if they want?
Well, it's only for our clients. So you would have to become a client of our wealth management division or buy one of our funds that do pretty well. So I think it's worth. And you can also drop me an email, and we'll do our best.
Okay. And you've probably started thinking about next year's report already. Is there a theme that you have in mind already?
Well, yeah. I mean, actually, on 1st of October, we will really start working on the new report. And there's quite a lot of topics that we want to touch. It will be 50 years of Nixon ending the Bretton Woods Agreement. So this might probably a topic. I think it's pretty interesting that the title of the next World Economic Forum in Davos is The Great Reset. That's not a conspiracy story. It is really the title of the next forum in Davos. And if you follow it, you know that it's really quite influential. So I think we will touch the topics of inflation or stagflation and how to hedge from those scenarios. We will also talk about alternative currencies that are non-inflatable, like Bitcoin, for example. We're pretty vocal when it comes to Bitcoin. We just set up a fund that combines physical gold with Bitcoin and uses an option strategy to harvest the volatility in those asset classes. So I hope that we will not end up with 400 pages next year, but I'm not sure about it.
We do have one question here. Other panels have asked about the influence of ESG on investor decisions. Is that a factor for your views of the market?
Yes, definitely. ESG, we are talking about ESG in the In Gold We Trust report for 3 years now. This year we had an interview with the World Gold Council about their ESG initiatives. I think it is something I experienced that at big mining conferences. I experienced last year talking to CEOs that they were really serious about ESG. I think that 2017, 2018, it was like a topic that you brought up, on the very last pages of your presentation, but now it's really center stage. And I think, there's quite a lot of legislation coming in, for example, in the European Union, and companies just cannot afford not to have a ESG policy, and I think there's tremendous efforts being made, and I also try to make a difference. So we are featuring those ESG chapters always in the Gold We Trust report. We tell generalist investors that mining isn't something bad, but something that creates value not only for investors but also for the communities. That it's something that has to be done very cautiously, and I think it's really important because with many people that I talk to that don't have any clue about mining, for them, if they hear gold mine, they've got a picture in their head, basically with a small kid in Africa trying to get out some gold from a small mine, and I think we should really put out a positive message and tell people, those are big industrial projects, and there are of course disadvantages and threats, but it is clear for me that at the moment the industry is really doing their best to contribute positively.
We have another question. What would be the chances that we see gold being confiscated?
It is something, and this is for me as an analyst, it is something that is quite frightening. This question about gold confiscation is coming up more and more, and I've over the last couple of years, it was sometimes this question was asked, but now everybody seems to care about that. Now this means that people are really concerned about, government actions, what will be done in terms of financial repression and so on. From my point of view, this is not something that I'm seeing as a scenario over the next couple of quarters. I think that a big surge in the price of gold would also mean a big collapse in the confidence and the trust in fiat money. And of course, this is something that is for the whole system, this is a threat. But if we look at history and if we analyze gold confiscations, we come to the conclusion that it was basically always done in times of wars or before wars, and when gold really had a monetary value. So my view is that in the next crisis, which will probably be a monetary crisis, we will see a remonetization of gold, because it's no coincidence that the US holds 8,000 tons of gold, that the Eurozone holds more than 10,000 tons of gold. The Chinese are buying every ounce they can get. The Russians are buying. Turkey holds enormous amounts of gold. The Swiss, and the IMF holds more than 3,000 tons. So the biggest players and the most important players, they're sitting on big gold reserves, and I think at some point they will be revalued. And this might be, let's say, the trust anchor for a new currency that will be introduced at some point. And this shouldn't sound too gloomy, but if you study monetary history, it is just something that happens every couple of decades, and I think this will happen over the next 1 or 2 decades. So this will be a topic for the In Gold We Trust 2021. We will analyze gold confiscation and the drivers for it, and so we will touch on that.
Another audience question: will institutions make allocation to mining equity a permanent part of portfolios for the 2020s?
Well, I hope so. I think that when it comes to gold, we should not forget at the moment the allocation for institutional portfolios is roughly 0.5%. So it is ridiculous. When it comes to mining stocks, I don't have the number, but it will be much smaller. So I think the move that we saw over the last couple of weeks, and just for the ETF demand, which is a sign for institutional demand, I would say. It was up 21% in 2020. Just in July alone, we saw inflows of, I think, 160 tons of gold. So there is something happening. But I think that when it comes to mining stocks, it is not something that I see for big institutional players that will now pile into the market. It normally, those are very bureaucratic companies or institutions, so it just takes time. But I think with many mining companies now really being value stocks and delivering tremendous amounts of free cash flow, and what I said before, they're raising their dividends. There's lots of positive things happening. There's good M&A developments happening. So I think that it will more and more become mainstream also for institutional players, but I wouldn't expect that it's going to happen over the next couple of months. It is a process, and I think we're just at the beginning of this process.
And we have two audience questions about junior gold companies and ESG. What ESG aspects do you look for before investing in junior exploration mining companies? And what's your message to junior gold companies and juniors generally getting on top of an ESG strategy and being vocal about their results?
Well, of course, it is not such a big topic as with the producers, but I see for many juniors that first of all, there's quite a lot of stuff going on in terms of exploration. Again, I see that there's more appetite for riskier juniors, and I can just tell from flipping through the presentations that I get that ESG also for the juniors is becoming more and more important. I think that one also has to be careful and not overemphasize ESG. Of course, it is an important part of the strategy, but sometimes I feel those companies are only presenting their ESG initiatives, and they want to hide something because they are having poor results in the drilling or production. So it is something important. And we're seeing it in the junior space as well. But there, I think it is something where much more will have to happen. And this is also probably a process that we're going to see over the next couple of years, because we can tell that, risk appetite is coming back. So their budgets are getting bigger. And now perhaps those companies really have the time and the capital also to care about those things. While, 1 or 2 years ago, they just wanted to survive and raise some money to cover their G&A expenses. So now they're becoming, they're coming into a different stage.
Do we have time for one more question, Anthony?
Maybe sneak one more in there, but Ronnie, if you can keep the answer nice and tight, that would be great. We've run over, but this is so fascinating. Let's sneak one more in there. Our audience is really engaging with this.
I just wanted to ask about, I know that Ronnie has a very strong background in technical analysis. And what are you seeing about the short-term picture for investors?
Well, actually, September has got the strongest seasonality. I think that, I went on vacation in August for 2 weeks, and I said, perhaps gold and silver and the miners will take a breather. Everything looks pretty overbought now. Technical analysis says that such an extreme overbought situation is also a very positive thing, because it tells you that there's lots of investors waiting on the sidelines. So I don't see any big correction. I don't see gold coming down to 1600 again. Perhaps we'll go to 1850, whatever. Perhaps silver is coming down to 25, 24, something like that. But I can tell that there's so many players with deep pockets that just want to get in, that I just don't see this strong correction happening. And therefore, I think, we are in a bull market, and in a bull market, you should basically buy every dip. That's it.
Good old rule of thumb. Ronnie and Alicia, we're going to have to leave it there. I warned you, audience. Ronnie has lots of great things to say. Ronnie, we're going to need to get you back. The questions really started flooding in there. Fantastic job guiding the conversation, Alicia, and great to hear from you, Ronnie. I had my own questions I wanted to get in, but we're out of time. So extra motivation to try to get you back, Ronnie, and we'll carry on this discussion.
Absolutely. Thank you very much. Take care.
Thanks, Ronnie. Thanks so much, Alicia.
Thank you.
Thank you.
Thanks.